Hey, thanks so much for downloading the clip here. This is Levi from Harbor Capital, and we're excited to get a chance to speak with you about the potential of being an investor. I brought my good friend Kevin Dahlstrom into the studio here to record really just what you would get on a call with us as a potential new investor. Kevin I'll let him introduce himself a little bit, but he's a LP in a bunch of deals. You got to go find him on Twitter. His stuff is absolutely incredible out there. And so he's somebody who's been in the industry for a long time, knows the right questions to ask. And I figured it'd be a great way to just introduce, what Harbor Capital is and what it is that we're doing together as a partnership between GP and LP.
Awesome. Thank you, Levi. Thanks for inviting me. It's been a lot of fun getting to know you over the past year. We actually met on Twitter and have now gotten together in real life a couple of times. We've been rock climbing together, so I've gotten to know Levi quite well. And, I always like to say, everything starts with, are they a good person? And I'll just say right up front for everybody listening, everything I know about Levi, his personal life and his professional career suggests he's a good person. So that's a great starting point.
Gosh, that means a lot. Thank you.
Doesn't mean I'm not going to ask you hard questions today. But,
Please do. Please do.
So I've been, just a little bit of background on me so your listeners have context. I'm a longtime entrepreneur. I've had one foot in corporate America for a long time. And I've also been an, active real estate investor for many years, but always on the LP side. I always like the idea of being passive. And I'm not an investor with Harbor yet. We're talking about doing a few things together. So I'm genuinely interested to hear the answers to my questions. So if it's okay, we'll just go ahead and dive in. And I thought rather than kind of starting with your childhood and walking forward, we just kind of get straight to it and talk a little bit about your basic investment thesis today. The investment thesis for Harbor, what asset classes, what do deals look like, geographies, and so on.
Yeah, that's great. So Harbor Capital. It's interesting. Many people that I tell this are quite surprised, but we're only a year old. Started in early 2021, but it feels like we've got the kind of cheat to advance a couple of levels because I've done more than $400 million worth of real estate in my career. Started out real young, flipping houses, and actually had a pretty big crash in 2008. I owned basically the wrong kind of properties going into that market crash, and that has made me quite cautious and careful in what we're doing with Harbor Capital. I had a big, a successful exit of a real estate company that I had built, exited in late 2019, early 2020, and then started Harbor Capital a year ago. And so our thesis really going into this was just to choose one asset class that we knew we could become incredibly good at. An asset class that I had personally invested in as an LP myself, and then also had done, kind of a few deals over the years was industrial. Our office is based out of, our whole team is based out of Austin, Texas. And so really it just, as we started to kind of survey the market and look what was out there, Class B industrial in Houston, Austin, Dallas, San Antonio was something that we felt we could get extremely good at and had a very likely long runway ahead of it of continued growth and continued interest and demand from tenants.
Yeah. Well, I'm certainly long on Texas. I was born and raised there, even though I don't live there anymore. But what a lot of people don't know about Texas is, the great financial crisis was sort of at most a blip in Texas. The economy has been so stable and strong for so long. Did that actually drive a lot of your thinking in locating in Texas?
Yeah, originally I moved there because the other business that I was running, my co-founder was based out of there, and so that was our original back in 2015, which brought us to Texas. But moved there. My family loves it. Kids love it. It just is, we've somewhere that we've decided to make home long term. And then when we were looking for a place to invest, we didn't have to look far to see, incredible growth, sustainable growth. It felt like to me, it was the type of growth that's going to stick around. It's not, I look back at kind of what happened in 2008. And you look at the markets, the one I was in was Northern California. Many of the houses that were selling, much of the real estate that was transacting in a really unsustainable way. It was loans that shouldn't have been underwritten. It was buyers who really didn't need that fifth or sixth house. And many of them were buying properties that were kind of underwater from a month-to-month cash flow perspective. That just never happened in Texas, and that is certainly not happening today. There is sustained growth and real demand and strict underwriting from banks. And so it feels much more sustainable.
You talked about something I think is really important, which is focus. You've chosen one asset class. It's a hot asset class right now.
It is.
So let's walk through a little, dig in a little bit deeper. Take me through a typical deal, or maybe even an example of one of your deals. What does it look like? And get as specific as you can.
Yeah. So we typically look for some sort of value add. We don't want to just buy a deal on market at market price and hope for the best and hope that the market kind of delivers something that we can be proud to deliver to our investors. Instead, we look for a deal that's either mispriced for some reason, or often, I'll go through an example of a deal that we bought. I think we closed on it in November of last year. It was a 52,000 square foot building just north of Houston. We purchased it at a very reasonable, I think it was a 6.5 cap rate. And it had one tenant in there. That tenant had only been in there since the beginning of the pandemic. And the situation was that the seller, and he told, actually ended up becoming good friends with the seller. He told me that the pandemic happened and his building was already vacant because his tenant had left a few months earlier, and he panicked. He signed the first lease that came along. And so he had signed a lease with a company that sells I won't get too specific, but it's a type of a PPE that, basically it's tied to the pandemic, and kind of as we evolve and as we kind of learn what's happening with the pandemic, the product that they're selling is not nearly as needed. And so their business, while was once quite strong, is now pretty weak. And so the lease that was signed was at $6 a foot in a market that is arguably 10, even potentially as high as 12. So this lease is, let's call it 40% below market, but it had 6 years remaining. And so we came in, did a bunch of, months of due diligence trying to figure out, it's a market we know, but trying to figure out the property. Was it one we really wanted to be in? It's a fairly new building. It's just over 10 years old. And then we due diligence the tenant and find out that their financials are not great, and it's very likely that they might leave. And so we put that deal together with an extremely oversized buffer account so that we have money, just in case this tenant does, just in case and when this tenant leaves. And the hope is that, we're going to get them out. We're going to be able to go out to market with this product at the new rate. And what was a 6.5 cap turns into a above 10% cap rate for our investors. The big bonus, though, is we get to then refinance with a new tenant. And the purchase price was $4.2 million, and that then becomes $7 million or something in that range on a refinance. So,
yeah, it's funny when you're in a market where in-place leases can be a liability.
Yeah,
that's a bizarro world that I'm not used to. Mm-hmm. Talk a little bit about your capabilities at Harbor. There's a few different models that GPs use. Some believe in being completely vertically integrated. Some believe in doing a few things really well and outsourcing the rest. Where do you fall on that spectrum, and what do you guys do in-house versus not?
So if we have a property that is a single tenant triple net lease, which is most of our portfolio, then we manage it in-house. If we have one, we're actually working on purchasing a property right now that is 70 units, we will actually farm that out to a local broker who can be our eyes and ears on the ground and manage that property for us. We have, I cannot believe the quality of the team that we've assembled. I just feel blessed and thankful every day to show up and get to work with these people who are many of them, all of them, so much smarter than me in their own ways, and have the ability to understand the market well, and the drive and just gumption to be able to get after it. That's been just fantastic. So we've got a great team, and we're very easily able to handle the in-house operations of a single tenant property.
That's awesome.
Yeah.
Yeah, I think as a CEO, it's a good thing when you're the least smart person in the room.
That's right. That's what I strive for.
So you mentioned that you guys are off to a really fast start. It's a relatively new company.
Yeah.
Talk about last year.
Yeah.
And then talk about what you think the future looks like 5, 10 years, whatever.
Yeah, absolutely. So it's funny. We when I set out and it was just me, I had a little office I rented in a co-working space. I remember this it was like cubicle-sized office, and I'd close the door and it was just me in there. And I had all these stickies on the wall of how big of a team we want. And really, I kept looking at this as this vision of, because it's quite hard to just be alone in a room, and I'd built large businesses before. And so in many ways, this was kind of a reset for me. It was one I deliberately chose and wanted to do. But I remember very clearly our goal for 2021 was to buy $5 million worth of real estate. We closed out 2021 with $28 million purchased. And our goal for 2022 is to buy $100 million. We have LOIs out right now for $74 million. So I think we're well on our way, considering it's the beginning of January here as we are recording this. But even further down the road, I'm always the visionary in whatever company that I start. Further down the road, that kind of flag out on the horizon, you can barely see it. So far out is to get to $1 billion in assets under management by 2030.
Yeah.
And yeah, so we kind of work the math out and figure out how much we need to buy every year, and 100 to 200% growth is basically what we need to keep achieving every year.
Well, I think it's important to have a true north, or they call it the BHAG, right? Big, hairy, audacious goal. Not only for your internal purposes, but also investors want to know. Are these guys who have aspiration to grow or to steadily, quickly, or sort of stay the same? So that's super important to know that you have big aspirations. If you don't mind, let's shift gears a little bit.
Yeah.
I want to talk about some of your background, because I happen to know we've had dinners and beers together. I happen to know you've got a really interesting background. In fact, some of your personal story is what sort of attracted me to you early on. So talk to me a little bit about how you got here. Some of your hits and misses, and just what experiences as far back as you want to go were formative to you.
Yeah. So I started out raised in a family that was entrepreneurial, but certainly there wasn't much in the way of resources going around. One of four, and none of us went to college. We basically just had to figure out our own way to get through life. My wife and I got married real young. I was 18 and she was 21. I always say that I had to snag her before she figured out she was much better than me. I'm still thankful for that. We've been married 22 years now, and just started out with a bang. We bought our first house within a year of getting married, fixed it up ourselves, flipped it, and made, I think it was $65,000 off that first one. Started a coffee shop. I really just found this building. The building was kind of the first thing we started with. Found a building that was an old bookshop that had closed down, rented it, and I went in and did all the work myself, put all the plumbing in. And I remember, the city building inspector, he was basically teaching me how to do the work as I went along. I had them come out far more times than they normally would, but he was really gracious with me and helped. And so we built the first coffee shop and actually ended up opening a second chain and then selling both of those off about a year and a half later. And that was certainly not huge, but it was a successful exit at, I think I was 20 years old at the time. And then went from there and kind of jumped back into flipping houses. This was back in the days of the countrywide mortgages that were easy to get. And so they didn't look at the fact that I was, 20, 21, 22 years old and didn't really have income other than what I was getting off of flipping houses. And so we would do sometimes 2-3 houses at a time and go in and do all of the work ourselves. My wife and I would literally, we started having kids young too. And so there'd often be I have pictures in my head of us sitting there painting a room with a stroller with a kid in it right next to us. And so we did that for a while, and then took on, I still don't know where the guts came from to do it, but we bought at the time, the most expensive house that had ever sold in the city that we were working in Northern California. It was a house on 5 acres, and we went through the process to split up the land and sell off 4 1-acre parcels and kept the house on an acre and a half. And so this whole project took 15 months, but we sold the land for as much as we'd paid for the house, and then proceeded to sell the house for as much as we paid for it to start. And so walked away with, this was a very significant, $850,000 win. And I immediately got the bug for subdividing. And so then from there just got extremely aggressive with buying farmland, None of it was on market. I mean, I literally would go knock on doors, look up parcels, figure out who the owners were, find the, family that had it for years. Often you'd go knock on the door and they say, wait, do I still own that? I didn't even know I had that thing.
Yeah.
Buy these parcels, take them through the process to get them rezoned, put a map on there, and then sell to, I sold to KB and Lennar and all the big builders, started to get a reputation for that. And so throughout, I think this was 2004 or 5, when I started doing that, grew exponentially to where going into 2000, I think it was 2007, I had a big team, 10,000 square foot office. And we actually bought a home building company and brought their whole team in-house so that we could start to build on our lots instead of selling them. And so, this was kind of the peak of, I was 26, 27 years old, riding high, was making money on every deal we did, was getting really good at doing deals and learning that whole process. And then 2008 hit, and it was absolutely devastating. Going into that year, I had 400 lots that I had bought, owned, and most of them done, curb, gutter, sidewalk, all the underground utilities, and paid, I remember paying Swainson's Hawk mitigation fees and tree mitigation fees and all the, just enormous amounts of fees in California to get these properties ready to build. And then we're starting to build, had construction loans in place, and the banks basically just came back and said, look, we're not lending on this product type anymore. You haven't sold a house in the last 2 months, you're not going to sell one. And so we're not going to continue to advance on these loans. And so, this is the deep lesson that hurts so bad, is looking at this portfolio of properties that wasn't producing income, wasn't buildable anymore, and was a product type that the world was basically saying, we don't want that right now. And so I had to go through the just incredibly painful process of unwinding all of these businesses, doing short. Most of them we ended up short selling, and having lenders have to take a loss and investors have to take a loss. This was a definitely rough season. On the personal side, at the same time, my brother passed away, and then 2 weeks later, my business partner passed away. And really, I remember kind of taking that almost personally, just because my business partner had laid him off, and then he passed away 2 weeks later. And I felt like, of course I didn't, it wasn't my fault, but I felt like I had something to do with that. And so, this was just a really, I had never experienced anything this complicated before.
Those are defining moments.
Absolutely.
For sure. And
Absolutely.
I just want to interject a couple things, and then I want to catch up to today. One is, I know a lot of GPs in real estate, and it's amazing how many of them got their start in their early 20s by walking into a Countrywide office and getting their first loan on a home. We know several who've built big firms starting there. But then, this I will tell you, as an LP, I have a few kind of rules of thumb, and one of them is I never invest with a GP who's in one of their first few deals, right? Because everybody has to learn the hard lessons. You were in, wrong asset class, wrong time. A lot of people learned hard lessons during that time. You talked about that. But tell me a little bit about how that informed, what you're doing at Harbor today, and how have you used that to future-proof Harbor so that the same type of thing doesn't happen?
Yeah, it's funny. You talk to people now, and I feel like the kind of public perception of what happened in 2008 now looks inevitable. But the truth was, if you sat down in the beginning of 2008 with somebody, they were saying the market's going to keep going up, everything's fine, this is all sustainable, this is great. And so I think the biggest kind of, if I could break it down to the kind of the lowest common denominator of learning that I've taken with me, it's that nobody actually knows what's going to happen next. But what you can do is you can set up deals and structure them so that no matter what happens next, barring some major war, something that's completely outside of our control, I'm just far, far more conservative. We pass on hundreds of deals before we find one that we say, hey, this is a risk-adjusted return that we can get behind. And this is, 9 out of 10 of the scenarios that we can imagine, we have planned for with reserve accounts and lender relationships and, cash flow plans that show a 30 or 40% even drop in income.
Sure.
This one's going to be okay. through a very dark period, this one's going to be okay.
And yeah, that hard-earned wisdom is exactly why I don't invest with first-time GPs, because it's so important. And I'll tell you, I'm not an investor with Harbor. My favorite two asset classes are multifamily and industrial.
Yeah.
Because if you look at the macro trends, all the tailwinds are favorable, and you can argue the market's been extraordinarily hot in both of those asset classes for the last couple of years.
Yeah.
But then you look at the macro trends, and in the case of industrial, the Amazons of the world need space. We're space constrained. So talk a little bit about that. Just kind of what the tailwinds of this market that you've chosen.
Yeah, I mean, what was a massive move for decades to offshore to kind of cheaper locations to produce has shifted and become, what can we produce here locally so that we won't have the same supply chain disruptions? And what can we do to, for people who are continuing to produce globally, maybe they've gone from, one country to 3 countries as a source. They're saying, what can we store in country so that when these supply chains do get disrupted, we'll have more stock on hand. And so, I mean, almost every one of our tenants that we talk to, needs more space today than they did before. The other, massive shift that COVID brought about was, the shift to online shopping, which, there's all these statistics about for every kind of dollar spent more on industrial real estate, on online shopping, there's a certain amount of industrial real estate that's necessary. Those trends continue to be strong, and I think as that happens, that's our goal, is to be there with it, owning as much of this real estate as we can.
Yeah, I mean, you don't have to be a genius or a futurist to believe that online shopping is a trend that will continue, and therefore will require more industrial and
COVID accelerated it.
Absolutely,
and we still haven't caught up. We will someday. There will be, all markets normalize. There will be a day, 3 to 5 to 7 years, who knows when, in the future, when it normalizes and we don't have the same surge in demand that's going on.
And out of curiosity, do you think about your specific business? Like, do you guys play in specific niches in terms of sub-geographies or specific sizes of deal, or what are some of your specific guardrails when you're thinking about a deal that suits Harbor?
Yeah, so we've gotten really good at single tenant properties. It's something that we're finding higher returns and the ability to basically get to know these markets better and understand what the demand is. And typically, when we bought a building recently, it's a 68,000 square foot building, and it has, it's vacant. And so we're now trying to find a tenant. We got an incredible deal on the buy. And once we find a tenant, this thing's going to be just a home run for us and our LPs. Every tenant that comes knocking on our door, we already know about them. We knew their need for space. There's kind of no surprises because we've done so much market research and know our potential tenants and know the needs in the area so well.
Awesome. Well, let's get back to a little bit more on your background. Maybe talk a little bit about some of your kind of personal formative experiences. I know, like me, you have children, you've lived all over the world. What are some of the things you've done that have kind of informed the person that you are?
Yeah. So after 2008, we spent time working on cleaning everything up and working with investors, and many of them are still investors in our deals today, which I am so thankful for them. You'd think it would be this just bloodbath of angry phone calls, and there certainly were some of those, but for the most part, I am so thankful for the investors who lost money with me in 2008, stood up and held my hand through that process and helped me figure out how to navigate those waters, and really helped me kind of figure out what was next. So my wife and I actually, after it was in 2009, after kind of everything was over and we were trying to decide what to do next, we heard about a situation in Ethiopia where there were basically some orphans who needed a organization built around them. And so we signed up to go, I still can't believe we did this, but we moved our family to Ethiopia. Really, the plan was we'd be there for 6 months, maybe a year, set up this organization, kind of take almost like a gap year, if you will. I knew I wanted to do business, but I was going to take a little break and kind of regroup as a family. I mean, there was certainly a lot of stress on us. We had 3 kids at the time. There's a lot of stress coming from, everything that we'd gone through coming from me. And so I felt like I kind of owed it to my wife. She was really passionate about what we could do. And so we moved over there, started an organization. It's still going today. One of the proudest things that I feel like we've accomplished together. My wife and I was really getting this thing up and running. And so we built started a 501c3 in the US and an NGO in Ethiopia, have a couple of hundred kids that we've been able to rescue and put into, it's a family style. So we basically find a widow from the community and then put 6 kids in the home with her. Yeah. Incredible. So thankful that we had that experience. We ended up living there for 6 years, though.
And you did some real estate there, right?
And did some real estate, yeah. So it's funny. So while we were there, we struggled to get a work permit in order to stay there, because for nonprofits, they just almost never give a work permit to a foreigner. And so I needed to start a business. And so we went out and kind of threw out a bunch of ideas, and I ended up starting and pulled a partner in to do it with as well. We ended up starting 4 different businesses, raised over $120 million for those businesses, the largest of which was a apartment developer. And so basically wherever there was a U.S. embassy, we would go buy land nearby and build an apartment building and rent to the U.S. government. And so when I sold all of it in 2019, that business had a $1.1 billion pipeline of apartment buildings that were either under construction or in negotiations with the U.S. government.
Well, I was reminded when you were talking about that, the first I ever saw your name online was a thread that you did about an apartment development in Ethiopia. And I remember thinking, this is one of the coolest business stories I've heard in a long time. And I think that's actually how I ended up meeting you. It's just fascinating. And, of course, as you know, nothing changes your worldview, expands your mind like international travel, especially living internationally. So I just think that's a really, really interesting piece of your story.
For sure.
So what I'd like to do now, because as you and I know, we have to be careful because we can talk for hours very easily. And I doubt listeners want to go through multiple hour background.
That's right.
But I'd like to kind of do a lightning round and just like some quick facts, because there's a lot of things that LPs just want to know in the course of business of like, hey, if I become an LP, what does it feel like for me? So let's talk a little bit about the LP experience with Harbor, and I'll just like hit on things like, your typical deal size, your typical like leverage, your typical check size, what does your typical investor look like, and so on.
Yeah, great.
Yeah, well,
go for it.
Go for it. Yeah. So why don't we start with like the obvious question as a lead-in. It's like, I'm an LP. Like, what's a check size look like?
So our minimum is $50,000. Our average, I think our last deal, it was like $125,000 or something. So we typically do a deal with 30 to 50 investors in every deal.
And what's a typical investor look like? Is it are they real estate guys? Are they experienced, inexperienced, and a little bit of all the above?
Definitely all of the above. I mean, we've got quite a few doctors and lawyers and people who are basically trying to kind of offset their W-2 income and the taxes paid, because I mean, that's one of the major benefits of investing in real estate is you get to write off through accelerated depreciation. So everybody loves those negative K1s that we deliver. But very wide range of investors. I mean, I would venture to say there isn't one kind of typical, everybody's so different in our investor group that there's really not one typical investor type.
Well, I'll just say in general, as I plug, not just for Harbor, but for being an LP and investing in real estate in general, I didn't discover this world, unfortunately, until my early 40s. I'm 51 now, and I wish I had known this world existed earlier, these private market real estate deals. And, if you find the right GPs, just it's been an amazing investment experience. And, I have a large portion of my net worth for many years has been in these types of deals. So for all the young people out there thinking about, like, I hear all this great stuff about real estate, where do I get started? Starting as an LP with a quality GP is the best way to get started.
Yeah,
right?
Definitely.
It's just to dip your toe in the water a little bit. So
for sure.
Highly recommend it, whether it's with Harbor or elsewhere. One thing that also LPs want to know is, like, what kind of skin in the game do you have? Do you personally invest in every deal that you do? Talk to me a little bit about how the structure works.
Yeah, we do. And it's funny that number is going down over time, because there's obviously not an unlimited amount of capital to put in, but we typically do around 5% of the equity needed for every deal. We put that in, or I put that in, I should say, myself, into every deal.
Awesome.
Yeah.
And then what is it? So on an ongoing basis, let's say I invest in a Harbor deal. What does communication look like? What does it mean to be a passive investor in a Harbor deal?
Yeah, so we use Juniper Square like many other GPs do and love the software. We do monthly updates and then quarterly distributions. Like I've said many times, we significantly overraise, so we have a good bit of capital available. So what that means is that our updates are kind of uneventful. Yeah. We typically don't have much news to deliver, certainly not much in the way of negative news, because even if we have a vacancy or even a prolonged vacancy, we have the capital available to be able to handle it.
Yep. And do you get your K1s out in a timely manner?
We sure do.
Experienced LPs always want to know.
Yeah, I was just talking to my CPA this morning, and we're shooting for mid-February. So yes.
Okay, great. All right. Well, this has been fantastic. Hopefully, a good overview of kind of who you are and what Harbor's about. Anything else that we missed that you want to cover?
Yeah, I mean, there's a few changes that we're doing. Our last deal, we raised a significant amount of money in a short amount of time. We raised $10.8 million in just 9 minutes.
9 minutes?
Yes, which sounds all good and great, but I recognize that that's not actually sustainable for us or for our LPs. It kind of, I don't want investing with Harbor Capital to feel like buying concert tickets. And so we're moving to a new system where investors can actually opt to kind of pre-secure a set. Say you want to invest $100,000 into every one of our deals, you can sign up to commit. We just have a quick verification of funds to make sure that we can count on you to be able to do this. And then of course you have the ability to opt out, but we want to kind of give investors who know that they want to continue to invest with us the option to be able to do so and not have to kind of stand in line and make sure they get it. And then we're going to start rolling out really in groups. So existing investors are going to get days to look at the deal and decide if they want. And then we go out to our more than 700 people who are on the list now who haven't yet invested. And we're going to actually break that up into groups. So if you get an email, it's pretty much guaranteed that you can have an allocation within the next few days. And so that way it's not kind of broadcasted to everybody all at once and you've got this mad rush to the door to make sure you get in.
That's right. It's a quality problem to have as a GP, but it's a problem nonetheless, and it does frustrate LPs.
Yeah.
And I think it's happened with a lot of folks like yourself who've gained fairly large followings on Twitter, and you've got a lot of investors who want to get started. Is how do you deal with that whole situation?
Yeah, not a problem that we anticipated having, but certainly one that we're trying to work through thoughtfully and make sure that we just honor the fact that these investors are trying to invest their hard-earned capital with us. And we don't want that to feel like, this fear of missing out or rushing them to make a bad decision. Right. I posted the other day, it didn't get nearly enough traction, but, the director who made what's that show, the John Adams show on HBO, also made the movie Cats.
Oh, that's right. I remember seeing that. Yes.
And it's interesting to me because I feel like often people will go to a GP and be like, all right, anything you do, I'm in. But not everything is a hit. And I want investors to have the opportunity to be able to go through our deals and make their own informed decisions. We had a deal recently where it was an investor who I've worked with for many years, and he came back in the last one and said, I don't feel like this one's for me. You guys will probably do good on it, but it's not the kind of risk profile that I'm looking for. This one, it was a vacant building. He's like, I'll come in on the next one. And I really respect that, and I want investors to have that option.
Yeah, that's a great call out, because I will tell you as a longtime LP, the number one criteria for me is who is the GP? Are they a proven quality operator? But within that, I still look at every single deal, and they're not all for me. And in fact, there's entire asset classes that I avoid.
Yeah.
Just because my personal investment thesis doesn't align with that asset class. So that's a great call out. Well, great. Any other last things to mention for prospective investors out there?
No, man, I'm thankful for you for doing this, and just thankful that we have met so many quality people throughout this process and finding new LPs, and excited to build more relationships. My goal really, because I know the market is going to turn, is to build a bunch of very good, trusting, lasting relationships with LPs, so that when the market turns and we're out here, buying the dip of real estate, I want investors to still be signing up and writing checks with us. And so
absolutely. Like these long-term relationships and even the lack of liquidity in real estate, I call that a feature, not a bug.
Yeah.
Because
true.
compounding is all about time.
Yeah.
And so the last thing I'll say, and then we'll wrap up, is you set this goal of $100 million for this year.
Yep.
I'd like to set a date to come back next January, and I suspect you will have exceeded that goal, but we'll talk about it then.
That'd be fantastic. We'll have to update this every year. That sounds like a good idea.
Well, thanks for doing this, Levi. It sounds like you've got something exciting going and have a huge future.
Thank you, Kevin. I appreciate it.